Good morning or good afternoon, excuse me, everybody. Welcome to today's webinar. We have a little bit of a different webinar than we normally do. We're joined by Rudy Litavsky. He's actually in Chicago. You wouldn't know it because he's wearing short sleeves, but I guess your weather there is it still pretty nice?
Yeah, it is. We're right in that like peak fall season, but today was an abnormally warm day for us here in Chicago. So
Very
it's a
nice.
good one.
Very nice. It is also warm here, and hopefully we have, I think through Saturday, it looks like it's going to even get up into the 70s, 80s, and then I think our days are numbered. It's going to start getting colder. But it looks like we have almost everybody in, maybe a few people who are going to trickle in. So today, what we're going to do is we're going to be talking to Rudy. Rudy works for a company called Innovator ETFs, which stands for Exchange Traded Funds. And we've been using Innovator products for several years now. And Rudy has been a liaison for us with the fund company, has really done a great job. A lot of clients have Innovator funds in their portfolio, but we wanted to kind of open up the hood and help explain a little bit more about what these vehicles are, how they work. When we try to explain them to clients, a lot of times there's a little bit of confusion because they're not your typical plain vanilla investment, but we think they really do have a role in the portfolio. So Rudy, if you could give a little bit of an introduction about how the firm started, the founders, a little bit about what you guys do, and then we can kind of just talk back and forth. And then what we want to do is open it up to questions. So for everyone who's attending, if you hit the Q&A button at the bottom of your screen, you can type in any question you have at any point, and we want this to be as interactive as possible. So there's no bad questions, there's no stupid questions. They're all good. This is a kind of a very new concept to a lot of people. So we encourage the engagement. So go ahead, Rudy, and give a little introduction on the firm, and we'll go from there.
Absolutely. Yeah. Appreciate that, Josh. Thank you for the introduction here. And thank you for everybody for taking the time to join us today. Like Josh mentioned, I work with a company called Innovator ETFs, and we are specialists in what we call risk managed ETF investing. And so for us, that plays out through what we call buffered ETFs. So a little bit of background on us. Innovator, we were founded in 2017 by the two original co-founders of PowerShares ETFs, which some of you may have heard of. If not, that's totally okay. That's Invesco's whole line of ETFs. They sold PowerShares to Invesco. So they started the QQQ index, which you may have seen commercials for, kind of investing in the future. That was, their brainchild. They sold all that to Invesco and semi-retired at that point. Well, while they were, out of the game for a little while, they saw a need come up where people really like these specific types of buffered payoffs, but the way to access them was really inefficient, really difficult. It was mainly done through annuities and structured products. Some of the downsides of that are if you want to get into this buffered payoff, you have to lock up your money for 6, 7+ years. If you want to access it before the end of your term, you're going to have to pay a pretty steep surrender charge. You're being taxed annually at ordinary income rates, so pretty high taxes. They're not very efficient on that front, and there's all this paperwork involved with implementing these funds. And so there's a lot of difficulty there. And they said, this is a payoff that we ourselves would like. Somebody's got to be doing it more efficiently, and they just saw that no one was. So that's why Innovator came to market in 2017, was to solve for this need, to say, hey, how can we create these structured payoffs in a way that's more accessible for advisors and for clients? So in August of 2018, we launched the first ever buffered ETFs, and we've been doing this now for over 6 years. We've seen a lot of growth as a firm. Innovator is now over 20 billion in assets under management. We've seen a lot of competition come into the space, trying to copy what we're doing just because they see it as a valuable investment, and everyone kind of wants to get their own slice of the pie there. So we still lead in pretty much every measurable metric, just because, as I mentioned before, Innovator, we're specialists. Our goal isn't to be the next Invesco, largest ETF provider. We want to do one thing and do it really well. So that's why Josh and Jeff are using Innovator when it comes to the buffered space, because we've got a lot of offerings available there at the cheapest level for you guys. to get these types of structures. So that's a little bit of background on Innovator, still a little bit broad on buffered ETFs. So what is a buffered ETF specifically? Some of you may be aware from sitting down with Josh and Jeff and talking through this, but just to cover it from a very high level, what you're getting is equity index exposure with guardrails. That's the simplest way I would put it. So what I mean by that is you're getting exposure to the largest equity markets like the S&P 500 or the NASDAQ 100, that QQQ index I just mentioned. We also have exposure to small cap indices or international indices. So we offer this on a broad array of indexes. One of the main ones is the S&P 500. On that, what we're overlaying is protection or a buffer. So on the downside, you have a known and set amount of protection against losses over a 12-month period. So if you were to look at a 15% buffer on the S&P 500, what that means is in 12 months, if that index, the S&P 500, is negative, anywhere from 0 down to negative 15%, your fund is fully buffered or fully protected against losses, and you wouldn't have participated in any. If we see a repeat of a couple of years ago where the S&P 500 was down 20% in 2022, our 15% buffer will be down 5%, which is what we saw happen with all of our funds that year. So the market was down 20, that's now past your 15% protection level, and you start to participate again. You'll never give up that 0 to 15% protection, which is why market was down 20, you were only down 5.
And Rudy, how can you give a lot of people say, "Wow, that sounds good."
Yeah.
There's not there's no free lunch. So what's
Right.
the trade-off? So can you talk a little bit about kind of how you guys accomplish that as simply as possible?
Absolutely. Yeah. So the give up there is on the upside, right? So that's what your downside risk to the index is going to look like with that buffer. It's always known. Your upside is also always known. You're going to get the full return of the S&P up to a ceiling or a cap, a set level. That cap is always known before investing. Right now, our 15% buffer is giving you a cap at around 12%. So that means next year, if the market does 10%, the S&P 500 is up 10%, you would also be up 10%. If it's above that 12% level, and let's say the S&P has another strong year and it's up 16% next year, you would get capped at that ceiling of 12%. So that's your maximum level of return. And basically by setting that ceiling, that's how we're able to pay for the protection. So that would be a little bit more into the weeds in terms of how we're structuring it. But under the hood, essentially what we're doing is creating that buffer, and however much cost is left to pay for that buffer determines where that cap is set. So Innovator, we're not, setting that cap arbitrarily. We're not making money on the cap. That cap is solely there, that ceiling, solely there to finance and pay for that downside protection level.
Yeah, that's really good, Rudy. And insurance companies, as Rudy said, have been doing this for decades. Big banks sell these things called structured notes, which are the exact same type of structure. And what the funds are doing is they're buying the underlying index fund, and then they're purchasing and selling what are called options, right? Because this sounds like just like how can they do this? It just seems like too good to be true, but it's not. It's all mathematically based in the options market. And I think one way to think about this from an analogy perspective is it's kind of like, think of your house as the S&P 500 investment. What Rudy's firm is doing is they're renting out one of the rooms of the house. They're collecting a premium for renting out that room. And then they're taking that premium and they're buying homeowners insurance, which essentially says, look, if there's a big storm and things get wrecked, we want to have some protection on the downside, right? Maybe not the full amount, but a large chunk of it. So that's kind of a simplistic analogy, but I think that they're selling what's called a call option. They're renting out the room, right? They're collecting that income. That's what creates the cap on the upside. But then they're taking that income and they're purchasing something that says, if the market goes down more than this level, this option is going to actually start making money. And I know this is a crude simplification, but Would you say that's a reasonable way to think about it, Rudy?
Absolutely, absolutely. Yeah. So those options that are under the hood of our fund, or any one of our funds, are solely there. That's what I mentioned earlier, those guardrails. That's the math of the position to say, hey, we've set up these parameters basically to say, hey, if the market does X, Y, or Z, we have parameters in place to know exactly where we're going to finish on either the downside or the upside, right? So that's a
And,
perfect analogy, Josh.
and one of the kind of unique things I think we can go into next about the innovator funds is that unlike the annuities or the structured notes, which are basically, okay, you buy them today and in 1 year, 6 months, 2 years, okay, this is the outcome, you get your money back. These funds are liquid on a daily basis. They trade on the exchange. And so we are able to buy into these and sell into these on any day we want the markets open. And so to take that step further, right, what Rudy has been talking about is, okay, in a year we have this defined outcome where we know we're going to be capped at this and we know we have this protection on the downside. So Rudy, can you then talk through maybe with a 2022 example where we actually
Yeah.
got to see how these work is, okay, that's great a year out, but how about 1 month, but in the interim, what's going to happen? How does the fund work when the market's actually going down? It's not just going to stay kind of level like this.
Right.
So maybe you can kind of go into that, and it looks like we do have a question that's coming as well. But let's go through this example because I think it's
Sure.
really helpful.
Yeah. And would it be helpful for me to share my screen as I talk through that?
Absolutely,
Okay.
absolutely. You should be able to do that. I think
Yes,
I.
I can. Yeah. So let me jump to. So this is a tool that's on our website. Um, Anyone can have access to this, innovatoretfs.com. If you hover over tools, there's a lot here, but it's towards the bottom, this previous outcome period tool. This is just live data of every single one of our funds against the index that it's tracking. So you can see what does it look like on a day-to-day period, as Josh is mentioning. These funds are structured with an assumption that you're going to hold it for the full 12 months, right? So we're not worried about the day-to-day price movement. We're looking at, okay, a year from now, what can I expect the market to do, and where can I expect myself to finish? Now, as Josh was mentioning, they are ETFs, meaning they are daily liquid. So if something does come up in, let's say, 3 to 6 months, and you guys need to get your cash back out, what can you expect? Or as you're just looking at the quarterly statements that are being sent out to you, you're going to see price movement of these funds. Whereas in some of those bank issued annuities and structured products, you're not really going to see that price fluctuation. You'll only see the value at the end. So it's a little bit less transparent there, very transparent on our end. So what I like to say is we only have absolute certainty, or as we call it, a defined outcome at the end of the year, at the end of the 12 months. But in the middle, you have a high level of predictability. Generally, these funds trade with about half the movement of the market until we get closer to the end. And that's, again, because those options that Josh had mentioned are structured to give you the full value over 12 months. So the closer we get to the end of the 12 months, the more value that's realized. So what you're looking at here is a line chart of the daily price movement of one of our 15% buffer funds on the S&P, which is this dark greenish bluish line, against the daily price movement of the S&P 500, which is the light blue line, in 2022. So this is January 1st of 2022 all the way to December 31st of 2022.
And just to set the backdrop, Rudy, for that. So
Yeah.
beginning of 2022, we're coming off, right? COVID is ending. The market was up a tremendous amount in 2021. And then all of a sudden,
Yes.
inflation started coming up. The Fed raised interest rates about 4% over this year.
Yep.
Inflation hit 9% in June. The markets were down month after month after month. So it was a very difficult time to be an equity investor. I just want to make sure.
Exactly.
Yeah, people have that.
Thank you. Yeah. So what you can see here, you can kind of think about this gap between the two funds as that buffer. And what you're seeing is that gap is growing over time as more and more of the buffer is being realized. Now, if I were to go 6 months in, we're looking here at July. I can actually hover over, I'm at June 30th, 2022. If I hover over it, I can see all the numbers, break down the daily price of the ETF, how much remaining cap and buffer is left, and the S&P. So looking at this here, that bottom number, minus 20.5% on the S&P. Well, again, with a 15% buffer, you might say, okay, the market's down 20.5. I should only be down 5.5. Now that's true if this were at the end of the 12 months. Now, given this is our January iteration, you can kind of see in the ticker there, PJAN, that's our January version of the power buffer. So PJAN. This is only halfway through the outcome period. So you're not going to have the full 15 buffer, but you're going to have some of that protection. And you can see the return there, which is that third number from the top, that minus 9.63%. If you were to look at the statement that, Josh sent out to you, July 1st, you would actually see this on your statement. You would see that loss of minus 9.63. And if you wanted to sell that day, you'd realize the loss of 9%, 9.5%. Now, the S&P was down 20.5%. So you could also look at that and say, hey, I had a 15% buffer, 15% protection. Well, I've realized essentially 11% of that 15% buffer already. I still have 4% more to go if I hold on to this through the end of the year, which is, again, what we kind of saw. We saw that protection grow till we realized the full 15% buffer at the end of the year. This is what you're going to see both on the downside and on the upside. So when the market then rebounded in 2023 and traded up, we traded up as well, but with less movement, less volatility, to where we realized that full upside at the end of the 12 months. So the big thing to remember here is, with Josh and what Jeff are doing in their portfolios, they're not, trying to time the market and get in and out at the right point. What they're trying to do is keep you invested at all points and say, hey, we're not worried about necessarily the day-to-day movement of this ETF because we know in 12 months exactly where we're going to be. Now, if there is a unique circumstance that pops up and you guys do need to get your cash out, we can sell that fund for you on that day for whatever the value is and walk away without having to pay any surrender charges, which if you remember from earlier, some of those bank issued notes and annuities, if you do have that event come up, whether that's purchasing a home, a kid's going to college, or a surprise medical expense where you need to liquidate out some of your holdings and get cash, on top of not realizing the full potential of that annuity or bank issued note, you're also going to pay a large surrender charge for taking your money out early. That's a huge benefit of the ETF is there's no surrender charges. The only fee you ever pay on these is the internal expense. And that comes out slowly over time, just like any other ETF does. All ETFs have an internal expense, and they slowly come out of the fund over time. So you're not going to pay any fees for buying in or for selling out, whether you're selling early or after the outcome period ends. You're never going to be forced out of the fund. It can roll for you automatically every 12 months. We'll never force you out and need you to repurchase back in. So I've covered a lot of ground there. I'm hoping that all makes sense. I know there's a few questions. Would that be helpful to jump into, Josh, or did you want to add anything?
No, I think that's exactly right. We're about to get into the questions here, and that's fantastic. I'm happy people are asking them. The way Jeff and I think about using these vehicles is particularly we like to use them after the market has kind of reached new highs, right? There's a lot of optimism baked in, like there is right now. You have multiple years of double-digit returns because generally speaking, in those events, you get one catalyst to the downside and the market's very vulnerable. When the market's already at a low point, right, it's not quite as appealing because, right, the bias is more to the upside. But we think of these being used strategically where the market is kind of reaching new highs. There's a lot of optimism baked in, and we actually take some risk off the table and buy something like this with a 9 or a 15% buffer with the idea that, yeah, we may not keep pace as much on the upside if the market keeps going up. But if the market has some volatility to the downside, we're going to be less exposed, which, believe it or not, especially in retirement, that volatility part of the equation is incredibly important because it's not so much the average return you get, but when those returns occur. And so this allows us to have a narrow range of outcomes. And when the market's already up a lot, it helps to, protect more on that downside. And the easiest way to think is if the market goes down 50%, you need 100% return from that point just to get back to where you started, right? And so we want to prevent, advance and protect as much as we can. Let me go to the Q&A. What is the estimated annual payout is the first question.
Yeah. So there are no annual payouts with these specific funds. This is all price appreciation, right? So that would be realized solely through the fund price increasing in value, so long as the S&P is increasing in value. So your estimated annual payout would be more of an upside cap or ceiling, which I can kind of show you. We have
go to a 2023 one maybe here.
Oh yeah, let's look at that. I'll show you what it did last year.
So it was down 5 and the market was down 20.
Then the next year,
it's the same fund.
Yep, same fund. Next year we had a much higher cap because of a significant increase in volatility and a significant increase in the rates, as Josh was mentioning earlier. So this next year the market did just over 24%, and we hit our cap, less expenses, right? So we underperformed by 5% there. But if you were to combine those 2 years together, we significantly outperformed the S&P, because when the S&P is down 20% last year, a 20% return doesn't get you back to even. What you need is a 25% return. And so what they saw was basically that. So it just barely broke even over the 2-year time frame. Maybe a percent or two above break even when you consider dividends. Whereas PGAN here was only down 5% the year prior. So this year being up 18%, we finished up double digits over the 2 years, as opposed to the S&P only being up just about 1.5% over that time frame.
And even in an up year, right, you have periods of volatility. So the summer of 2023 was a little bit of a volatile period. So if you go down, you can see the max decline intra-year on the S&P 500 index fund SPY was 10 and change, and PGAM was down roughly half of that, right? So even in the midst of an up market, you still get some of that protection on the downside. And it goes, again, for many clients, this goes a long way to, as Rudy said, ensuring people stay invested. Rudy, if you're good, I'm going to go to the next question, if that works.
Absolutely, yeah.
If options are used for downside protection, they also used to supply some or all the upside return.
Yes, is the short answer. So the basket of what we're holding within our fund are 4 options positions. This is a little bit, kind of in the weeds, 201 level knowledge of the buffers, but all it comes down to is one call that's the same thing as owning the index, right? So we're just buying one call that replicates the index. Then the options on the downside are what are called a put spread. So that's a protection, right? So that's just 2 options that create a buffer. And then it's a call, a sold call on the upside that pays for that protection and creates that ceiling of return. So the reason I mentioned that it is all options based is because there is an entity called the Options Clearing Corporation, or the OCC, that guarantees all of these options for settlement. So you don't have any credit risk or counterparty risk with Innovator when you own these funds. Because if something were to blow up and Innovator goes out of business, and surprises us all, what would happen is at the end of the outcome period, at the end of this 12 months here that we're looking at, you guys would be cashed out of the fund as if Josh and Jeff had just gone in and bought the options positions themselves. So instead of it automatically renewing like we would be doing it, it would just cash the Options Clearing Corporation, would cash you out of that position because you are the actual holder of those 4 options. If we were to do it differently, it would create potential for you being on Innovator's credit and there being credit risk for you. So that's why I mentioned that it's exclusively options that create that payoff, because that completely eliminates credit risk and counterparty risk for you while you're holding these positions.
That's a really, really important point, because when banks do these structured notes where they could do roughly the same thing, although generally the fees are higher,
Mhm.
You have credit risk because the bank you're buying, essentially loaning the bank the money in the form of a note, right? Hence the word structured note. That's not what's happening here. So this is, in our opinion, a better vehicle on so many fronts: liquidity, taxes, cost, credit risk. So it
Right.
really is just a better vehicle.
And that's not unrealistic to consider because that's what we saw in 2008. We saw a credit squeeze again a couple years ago with some banks. And so that is something to consider.
Absolutely. I mean, it's
Yeah.
unusual, but when
Right.
if you're doing something to protect on the downside, you don't want to have that the additional risk that the company you're doing it with could go under.
Yeah.
The last question is a really good one, which is, okay, this is annual, but wouldn't potentially you want to do some of this like a little bit each month? And that's kind of a nice segue into how we use your vehicle, because that's exactly what we were thinking.
Yeah. Do you want me to talk a little bit about that, or do you guys want to jump into your use of Buff B and other funds?
I think you can lay it out like how that we
Okay.
use Buff B. That's what
Yeah.
clients have, and how that
Yeah.
why we've done it that way. Yeah.
Yeah, absolutely. So I'll start with a little bit of that structure. So great question, Joe. When you look at this here, this PJAN, that's one ticker symbol, right? We offer these every single month. So there's a PFEB for February, a PMAR for March. We have the PNOV, the November one, resetting here in a couple days' time. So there's 12, 15% buffered ETFs on the S&P 500, one for every month. That's a great question. Then when do I get in? Do I buy the January funds? If I've already bought the January funds, should I buy the February? Do I need to be spreading it out? How do I manage this? Well, that's where advisors like Josh and Jeff will look at that and say, okay, I can do two things. I can either start buying a bunch of different months and kind of clutter up the portfolio where you guys might be a little overwhelmed to see I have 6 or 7 different buffers, and one's for January, one's for February, and others for July. That can get a little bit confusing. So we have some funds that simplify that down, and these are called our managed outcome ETFs. And what these are doing is they're holding an equal weight of every single one of the months together in one ETF. So then this way, you don't have to worry about when do I get in or when do I get out, or which month, I'm sorry, do I get into. I'm always just buying this one fund and I'm equally weighting it automatically across all of the months. So that way I don't have to say, okay, I bought the January. Do I also need to buy February now? And do I need to then buy March? And now I've got to manage all these different positions. With one ETF, I can wrap all that together in one bundle and say, now I've got a blended average exposure to a 9 or a 15% buffered ETF. So that's structurally what these managed outcome ETFs are doing. I know Josh has talked about BUFB. A lot of you may have seen this fund on your statements. This is the same exact thing we were just talking about with 2022 and 2023 performance. This is just with a 9% buffer against losses. So that protection comes from 0% down to minus 9%, and then participation beyond. The reason you might opt for a 9% buffer is because less protection, you're going to get more upside potential. And so instead of maybe 12% upside right now, you're getting more like 15, 16% upside over the next year. So there's always a trade-off. The 9% buffer is still covering you in a vast majority of negative markets, and then giving you a little bit more upside juice over the year.
Yep. And you can kind of see, like, for most of the last 2.5 years, Buff B was actually doing better. It wasn't until really the last couple of months since the summer when the market just continued to propel higher. But what's interesting is, like, you could get, if you go down just a little bit, Rudy, the fund NAV since inception is up 9.5% annualized. The market is up more, right, at 11.3, but you had a lot less volatility on the downside, right? And
Right.
so, again, depending on what your investment objective and goal is, if you get a volatile market, this type of a vehicle, over the market cycle can do, a lot better, in my opinion, than kind of 50% of the market upside, but with about, only half of the market on the downside. And so we just think it's really appealing. We just think this is a very appealing kind of strategy. There, yeah, you're
You can
showing
see
it here.
those numbers here, significantly reduced volatility
Right.
and significantly reduced maximum drawdown in the portfolio, which is exactly what Josh is talking about. There, yes, though that performance matters, but a big part of that is how much risk did we take to actually get that level of return?
Right, exactly. So what Jeff and I are always looking at all points in time is over the next 2, 3 years, right? What is the anticipated return? And then how much risk do we have to take to get that return? And we want that ratio to be as high as possible, right? Highest possible
Hmm.
return, lowest possible risk. And
Yeah.
we think that this does a good job of kind of optimizing for that. We do have a couple more questions, which is fantastic. Um, okay, so are there fees paid to purchase the product? So when we buy in or sell these, there are no fees. It's a no load, not even a no load. It's just on the exchange. The only fees, I think, was it 79 basis points per year that Innovator charged?
Correct.
Yeah. So
Correct.
it's 0.79% per year for them to essentially do all of the work for
Hmm.
buying the calls, selling the put, or selling the calls, buying the calls, buying the puts,
Yep.
kind of managing the whole thing. So that's the only kind of cost to the client in terms of this. But no, there's no upfront fee or anything to get in or to get out.
Yeah. And to put that in context as well,
Yeah.
it's about 0.8%, right? Most of the annuity companies and structured product companies are going to be looking at on the low end about 2.5% fees or higher. And that's just on the actual product. That doesn't include buying and selling fees or surrender charges that you'd have to pay on top of that. So historically, to get this type of payoff, you were having to pay close to, if not over 3%, for this type of structure. So great question. And then last one, it looks like Joe's kind of had a follow-up
Yeah.
on should
Okay.
these be bought at the start of the period or buy during the term. So that's part of why Josh and Jeff are using Buff B is because it's blended out. There's no optimal purchase date, right? We can get in at any point and know we always have this rolling and blended 9% buffer strategy. Now, if you were to look at buying one of the individual months, that's where I would recommend, and what Josh and Jeff are doing is if they are buying an individual holding to complement this Buff B exposure, they're buying it at the start of the period, right? Because those protection levels, that buffer and that ceiling or that cap, are set at the starting date. So you want to try and get in around that starting date just to get the maximum protection and the maximum upside out of the fund. But when you're looking at Buff B, which is what most of you are holding, and what Josh and Jeff are mainly using, this is meant to be an evergreen perpetual solution. So you don't have to worry about when you're getting in. You can always allocate to Buff B and know I've got a blended 9% buffer on the S&P 500.
And, and we're not using it this way, but Jeff and I, as part of our due diligence, have explored this with Rudy. I know a lot of of our clients on here are retirees and more income focused. Can you talk about a little bit about some of the products you have that are more where the focus is just the payout and the income and how you guys how the buffers work around those, the barriers?
Yeah, absolutely. So buffer ETFs are a big part of what we do. We do also offer some buffers that instead of capital appreciation, right, instead of that upside ceiling potential, we're giving up all of that for a known and level stream of income. So uh, if I jump real quick to our defined income ETFs, um, actually, so I'm not putting anyone in jumping all around on the screen at one time. I'm going to show you guys what our October rates looked like, and we'll just talk from there because that'll be a little bit easier. We can see everything we have. Okay. Oh, let me resume sharing. Okay, so these bottom two here are where I'm gonna start here because this will be the easiest to initially understand. What we're looking at here is a 9% buffer ETF. So same thing as Buff B. You're protected on the downside of the S&P from 0 to 9% down. So the S&P finishes down 9, you're not down any. The S&P finishes down 15, you're down 6 on a price return level, right? If the markets are positive, we're not getting any return. We're giving up that positive return potential. And what we're getting instead is a level distribution of about 6% over the next year. And that's going to be distributed monthly. So you're going to get, a 0.5% distribution of that each month. And so your only risk here is, hey, if the market does more than 9%, I could lose on my price return, but I'm never going to give up that 6% of income stream. I'm always going to keep that income. It's going to be distributed out monthly. And while I am giving up that capital appreciation, right, that price increase, I am going to get income distributed to me monthly so I can use that to help make my payments and live off of in retirement. There's also one with a 15% buffer. So you want to increase to that 15% protection, a little bit more downside protection, again, costs on the upside. So 6% net of fees, about a little over 5.2% net of fees here, with a little bit more protection.
So just to make sure we zero in on, just take the last one.
Yeah.
What you're saying is if the market is up, if the market is down less than 15% between October 1st of this year and October 1st of next year, so it could be up 30, down 14, the client is going to get, after the fees, as you said, basically from this fund, it would be a per month distribution of roughly a little over 5%.
Exactly.
Right?
Exactly.
Okay. And if it's down more than 15, the S&P over that time frame, they would still get the 5% yield, but then they would, but the price, what they would get back would be adjusted down for the amount that the SPY was down beyond the 15. Is that right?
Exactly. So if you put $100,000 into this fund and the market falls, fit to 20%, right? You're going to be now at $95,000 because you realized a 5% loss.
Right.
But you did receive that original 5% of income, which was $5,000, and offset you. So you're still at 100 in total.
Got it.
Yeah.
Okay, that's really helpful, right? So you guys can get a, right? You're looking at net of fees, 5 to 6% return.
Mm-hmm.
The market, how often does the market decline more than 15% over an 12-month period? Is it 1 in 6 years? Yeah.
If I remember, a 15% buffer covers you in about 80 to 86%, somewhere in that range of all negative markets.
Okay, there you go.
Yeah.
And then the barrier is a little bit more confusing, but again, let's go over it. We're here on the webinar. Let's give it a shot.
Yeah, absolutely. So the barrier is very similar. Structurally, it's going to work the exact same way as the buffer. And for if you guys are looking, it's these top 4 ETFs that I'm discussing right now. These are our barrier ETFs. The bottom 2 are the buffers. I'll talk about the difference in the language there in a second because that's really important. But in terms of receiving your distribution, your income, functionally it works the exact same way. If the S&P is positive, flat, or negative within your protection level, you're at 0% on a price return. Your money is still, your principal is still at the same level. And then you received the monthly distribution. Or actually, I'm sorry, these are quarterly distributions. So that is one nuance as well. These distributions will be quarterly. You will have received that over the year. So again, 40% barrier here, 5% of income. You're going to receive that 5% distributed quarterly in this example, all the way up to a protection level of 40%. Now, the important difference here in a barrier versus a buffer is a buffer, you'll never lose or give up that protection. Even if the market falls 85%, you're only going to be down 60% and 15 buffer. You're always going to keep that 0 to 15% protection. Now with a barrier, you could kind of view it as like a cliff of protection. So you're fully protected all the way up to that level. And then if the market were to pass the barrier, you would take on the full loss of the market and you'd lose all of your previous protection. Meaning with a 40% barrier, which is our most defensive, if the S&P is down 40% over the next year, you're fully protected. you got your 5% of income. But if it's down 41%, you still keep your 5% of income, but you're also down 41% from your principal. Now, talking about risk there, a 40% and even 30% barrier protect you in over the 40 is over 99% of all markets. It's very, very rare that we've seen a 12-month period where the S&P has been down more than 40%. Almost just as rare that it's worse than 30%. A 30% barrier is like 98 point something, 98.4, I think, percent of the time you're fully protected. So it's a very, very rare chance that you see a 30 or 40% drawdown in a year. The 10 and 20% a little bit more likely, which is why you're getting much more income, right? So what you're seeing here on the 10% level might be more comparable to some of those high yield fixed income positions that you guys might have in the portfolio. Because again, just like your high yield bonds, they are riskier.
Yeah. Jeff and I haven't yet gotten comfortable with the barrier ones just because
Yeah,
psychology around, well, we're down 30, only 10 more to go, and then we
right.
lose them. So, but look, there's lots of arrows, right? Lots of tools that Innovator's giving us.
Hmm.
Can you talk a little bit about B alt? Because that is something that we view kind of as a bond, reasonable bond proxy type of investment.
Yeah,
Again, we're getting a little bit into the weeds, but it's yeah. If you have more questions, please send them into the Q&A chat. We'd love to see them, but we'll just keep
yeah,
going.
absolutely. So B alt is this fund here. The ticker symbol B alt was short for bond alternative. So the goal was to create the most bond-like structure we could, but use a completely different risk profile, so that the underlying risks associated with that fund are completely diversified from what some of your traditional bond positions may be. So what you're getting here is a 20% buffer. So that means you're protected from 0% down to minus 20%, right? Over a much shortened period, over 3 months. So to see any losses in this B alt fund, the S&P 500 would need to drop more than 20% in a calendar quarter, which again is also a very rare event. We've only seen 4 calendar quarters since 1950. So over the last 70 plus years on the S&P, we've only had 4 calendar quarters that have been worse than 20%. And if you averaged out those 4 quarters, the average loss was minus 23.5. So if we were to see that, B alt would be down 3.5% that quarter, while the S&P is down 23.5% in that quarter. But again, 99% of the time, you're not going to see it past that 20% buffer, so you're going to be fully protected in those negative quarters. What you're getting is a much lower upside potential, right? You're seeing 2.6%, but remember, that's not for the year, that's for the quarter. So if you were to annualize that number out, consider it over the full 12-month year, you're getting about 10% upside here while being protected each quarter against the first 20% of losses. Now, the reason this is so popular is, well, sometimes the S&P has a really bad year, but it might have a couple of decent quarters. So if we think about 2022, I'm going to show you guys a quick little story on 2022. If you remember from our conversation earlier, the S&P was down about 19.5% that year. This is breaking that down by quarter, right? So this is total returns by quarter. So this is including the dividend of the S&P. At the end of the year, the S&P, including the dividend, was down 18%. BALT, however, finished positive 2.5% net of fees. And the reason for that was the S&P was really negative over the first 3 quarters, but never more than 20%. Even at the worst, it was down 16. So what you see is BALT is only down that internal fee of about 0.2% per quarter. And then in the fourth quarter, the market rallied a little bit, did just over 7%. So we were able to capture that up to our cap, which was about 3.3%. So at the end of the year, we finished positive 2.5, even though the S&P was down almost 20. So the big thing is to remember, if we get just a couple positive quarters, we can have a positive year even if the S&P is down that year. And if you look at it against core bonds here, this is core bonds. This isn't, high yield bonds. This is supposed to be the safe money. Safe money really failed in 2022. You can see the S&P was down 18. You were almost down as much in your core bond position. It was down, again, 5% per quarter, rallied just under 2% in Q4 to be down 13% for the year. So we outperformed by 15% those core bond positions, which is why it makes such a great diversifier. Because while its risk profile is very familiar to a bond, it's derived from a completely different area. It's linked to the S&P. It's linked to the equity market with a buffer in place. So I'll pause right there.
Yeah.
Does that feel clear, Josh?
Sure. Yeah, to us, it's clear. Obviously,
Sure.
to the clients, we're starting to throw a lot at you, but
Right.
this is the kind of stuff that gives you a taste as to what Jeff and I are looking at beyond just your traditional mutual funds to kind of bring the best possible outcomes. And, I think right now we're primarily using the Buff B, but, as a lot of you have seen, like interest rates, went down. They hit basically a year ago. The 10-year Treasury hit 5%, went all the way down to 3.6%, and then like in the last month, it's up to what is it now? 4.3. And we just attended a due diligence conference in Baltimore T. Rowe Price, and a lot of the fixed income managers said it wouldn't surprise them to see 5% again on the 10-year. So I mean, there's a lot of volatility in interest rates, and when interest rates go up, the value of most bonds goes down, and the longer the duration of those bonds, the more susceptible they are. Mm-hmm. So that's not to say that's definitely going to happen. Obviously, right, rates are at a much higher levels now, and so there's a lot more attraction to buying fixed income. But this is a unique kind of vehicle as a way to kind of have a bond-like profile in terms of risk, but potentially get higher returns and be a diversifier. We do have another question that came in. I don't know, Rudy, if you can read that out to everybody.
Yeah, absolutely. So Joe asked, do the quarterly buffer ETFs automatically renew at the end of the quarter? Yes. So that is true of all of our ETFs. There's never a maturity date, but we call it a renewal or a reset date, where all that happens is Innovator, what we're doing is under the hood of the ETF, taking that options basket and renewing it into a new options basket. So we're always going to keep the same exact level of protection. You have three constants, right? It's the index you're tracking, it's your buffer level, and it's your timeline. The only variable you have is that cap rate or that ceiling. That is essentially saying, when we renew, what is the cost of that protection on the index? And that can vary at time. You're not going to see giant swings unless you're seeing giant swings in the market, which would generally be the volatility piece, that volatility component, which benefits our fund. So if you start to see giant swings in the market, that means volatility is increasing, and those cap rates, that ceiling is going to go higher. Basically, it just makes that protection cheaper for us, is all that is happening. So we're able to sell that call, create that cap at a much higher level. So it's going to automatically renew. You guys aren't going to have to do anything. Josh doesn't have to go in and change anything for you guys. Every 3 months, or if you're using the 12-month one, the annual one, every 12 months, it's automatically renewing that protection for you. So it's automatic, it's internal, there's no tax consequence. It won't affect your cost basis or your holding period. So if you guys hold these for a year and a day, and you end up selling, you're now going to be at a long-term capital gain rate instead of ordinary income tax rates, which are much lower, right? You can cut that tax liability in half, as opposed to the ordinary income tax rates that you guys are paying when you're using bonds and fixed income positions, which is another big benefit.
Yeah, so if you think about that, if you're getting 4.5% in the money market, if you're in a high tax rate, maybe after taxes, you're getting 3% a little. Right here, it's not income being paid to you, but it's kind of has a similar risk profile. 20% protection every single quarter is a lot. Mm-hmm. So like in this case, in 2022, you would be up 2.5%, but you wouldn't be paying any taxes on that money. It would be appreciation in the fund. So it's just, and then in 2023, just for reference, obviously the market was up a lot more. What was this up in 2023, the alt?
I think it was up around 8.5, 9%.
So like that's pretty unique.
Here, here's a look at the 2-year performance. I mean, this will include the 15 buffer as well. Um, so Balt is the light blue line here. It was up over that 2 years, a total of 10%. Like we talked about earlier, the S&P barely broke even. If you were buffered over that 2-year time frame, you significantly outperformed the S&P.
Yeah, and of course, like in fairness, this is a very beneficial time period to be looking at these
Right.
ETFs. It was a market peak, but that's why we're kind of trying to use these more as the market hits new highs every day.
Mhm.
And but again, it's a great case study for how these
Right.
function, why they're good. Was there another question? I thought we were at 5 and now we're at 7.
Yeah, I see one here that says, could you construct a complete portfolio on the tools presented here? Um, so yes, and we have pre-built portfolios. Now, what Josh and Jeff are doing is they're adding that into the existing portfolios, which is what a lot of people prefer to do as a slice of that bucket, right? That way we can look at our overall allocation and say, hey, with this portion, with this buffered portion, if the markets move in X, Y, or Z direction, we know exactly where this basket's going to be. It's kind of like our backstop. It's our defensive side here where we know with certainty what we can expect out of it in relation to the rest of our allocation. Does that feel like a fair representation, Josh?
Yeah, I think it does. I mean, I think you could construct a portfolio, but there are going to be times where you do want your traditional asset classes, right? You do want traditional fixed income that actually pays a yield, and isn't going to, have the situation where, oh, the market's down this much, all of a sudden
Hmm.
you're down that whole amount. And remember, the other thing is there's no active management in the sense of a manager is going in and picking a particular stock or doing underwriting with a bond to select one bond over another, which is fun. That's okay, right? This is looking at, all right, here's all the indices that's out there. We want to get indice performance, but with guardrails, right? And so it's looking at whether it's the S&P or the NASDAQ 100, like Rudy mentioned, or the Russell 2000 or an emerging market index, right? So we view this as kind of really valuable tools in the tool set that we can use to try to increase return and reduce risk. So, I mean,
Hmm.
I think you could construct a portfolio with any, right, with basically with any funds you wanted to. Um, but I think you're still having some traditional, Rudy, maybe you don't like hearing that, but I think you would agree having some traditional investment.
Absolutely.
Yeah.
Yeah, it's going to be obviously as you guys work pretty good client by client scenario. There are some people who they've called me. They're like, I don't use anything but the buffers nowadays, and that's for their retirement portfolio. That's what they want to do, and maybe they mix and match some of the buffer levels. But you know, uh, overall, that's not the goal. That's not helping you guys achieve all the long-term goals you're going for. And I would just add to kind of keep in perspective. We've covered a lot of ground here on the call, and I hope it's been helpful more than it's been confusing. But the reason I want to make sure we covered so much was because there are a lot of tools that Josh and Jeff have at their disposal with these buffered products for them to be able to say, hey, where do we want to turn the dial? How much protection do we need in the portfolios? And if we're really concerned about, what the next 12 months could look like, we have the opportunity to, turn that dial of protection up a little bit. Or if we're saying, hey, we're a little bit more cautious, but maybe it's a little bit more promising, we can turn that dial down to say, hey, let's get a little bit less protection for some more upside, but still keep that protection in play because no one knows what the markets are going to do. If we could tell you exactly what they were going to do, we'd all be billionaires retired on a beach somewhere by now. So this is all saying, hey, we need to keep you invested, but we need to have some level of protection. How much that level is going to be determines on whether we use something more defensive, maybe like B alt, or something less defensive like the 9% buffer and buff B. So those are just options that they have to be able to kind of turn that dial up and down on protection.
Yeah, and Rudy, I know we only have 5 minutes left. We do have one more question that
Oh
came in
yeah.
on defined, I think, income related to international and emerging market indices. I don't know if you guys have that yet.
We do not have income on the international ones. We do have the capital appreciation. So if you look here at the upcoming November funds on Friday, you can see this is all we've got coming up on this Friday, and there is Russell 2000, which is your small caps, and then we do have the EFA, the International Developed, offered every single month with a 15 buffer. We're expecting a cap of around 13.5%. So we have capital appreciation on the international space. We don't currently have the income there. I don't think that the income levels were necessarily different enough from the S&P to warrant adding that, from what I recall, as well as because it is a more volatile index, the likelihood of you losing um, on the price return side of it can be increased. So might be a little bit riskier.
It's really good. If there's any lasting questions, we do have a couple minutes left. Hopefully you guys got a flavor for kind of, what Innovator does. It's not as much of a black box, and you kind of understand how the sausage is being made. But they do a really, really good job. They have an incredibly broad suite of products, which we like, and Rudy is always available. I mean, even the fact that he's doing this webinar is a testament to the relationship. And if we ever need to get a question answered, we know we can go to an actual person who will be there to respond, and that means a lot for us. And we like that on behalf of our clients. So we
Awesome.
we'll leave things open just here for a minute or two. But if nothing comes in, we'll let Rudy get back to his day. But hopefully, this is something we'll make available to our clients, if they want to watch this after the fact. So if you do want to watch this again, you'll be able to do that. But thank you, Rudy, for doing this. Really appreciate it. You did a great job explaining things, and hopefully clients also feel like they got something out of it, and it was valuable for them as well. So
Great.
I don't see any more questions coming in, so we'll let everybody go, and enjoy an upcoming Halloween, and hopefully your weather stays warm for a little bit longer.
Yeah, you too, guys. Thanks so much for having me on. Hope it was helpful, and we'll stay in touch.
Okay, sounds good. Take care, Rudy.
Awesome. Bye.